Hello and welcome to today's video about ROE. What is ROE? ROE, or return on equity, is a financial metric that is commonly used to evaluate the profitability and efficiency of a company. It measures the amount of net income a company generates in relation to the total equity invested by its shareholders. ROE is expressed as a percentage and is calculated by dividing the company's net income by its total equity. The result represents the amount of profit generated for every dollar of shareholder equity. A high ROE indicates that a company is using its shareholders' equity effectively and generating a strong return on investment. ROE is a critical metric that investors use to evaluate the financial health of a company. It provides insight into how well a company is using its shareholders' equity to generate profits. A high ROE indicates that a company is generating profits efficiently and effectively using its capital. This is important because it suggests that the company has a strong competitive advantage and is well positioned to continue growing. On the other hand, a low ROE may indicate that a company is not generating profits efficiently, which could be a cause for concern. A low ROE could be a sign that a company is struggling to grow, or that it is investing too much capital into projects that are not generating significant returns. This could lead to a decline in the company's stock price and a loss of investor confidence. ROE is also an important metric for company management. It provides insight into the company's financial health and can help management identify areas for improvement. For example, a company with a low ROE may need to focus on improving operational efficiency or reducing expenses to increase profitability. It's worth noting that ROE should not be used in isolation when evaluating a company's financial health. Other metrics, such as revenue growth, profit margins, and debt levels, should also be taken into consideration. It's also important to compare a company's ROE to its peers in the same industry to get a better understanding of its performance. In addition to evaluating a company's profitability, ROE can also be used to compare companies within the same industry. For example, investors can compare the ROE of two competing companies to determine which one is generating a better return on investment for its shareholders. It's also important to note that ROE can be affected by a company's capital structure. A company that has a higher level of debt will have a lower equity base, which can result in a higher ROE. However, this does not necessarily mean that the company is performing better. In fact, high levels of debt can increase a company's financial risk and make it more vulnerable to economic downturns. Another factor that can impact ROE is the company's dividend policy. Companies that pay out a larger percentage of their profits as dividends will have a lower retained earnings balance, which can result in a lower ROE. However, this does not necessarily mean that the company is performing poorly. In fact, a company that pays out a high percentage of its profits as dividends may be attractive to income-oriented investors. ROE can also be used to evaluate a company's historical performance. Investors can track changes in a company's ROE over time to determine whether it is improving or declining. If a company's ROE is consistently increasing over time, it may be a sign of a well-managed company that is generating strong returns for its shareholders. Overall, ROE is an important metric that investors and company management should pay attention to. It provides valuable insight into a company's profitability and efficiency, and can help identify areas for improvement. However, it should be used in conjunction with other metrics to get a complete picture of a company's financial health. In conclusion, ROE is a critical metric for investors and company management. It provides insight into a company's profitability and efficiency, and can help identify areas for improvement. A high ROE indicates that a company is using its shareholders' equity effectively and generating strong returns on investment. While a low ROE could be a sign of trouble. As with any financial metric, ROE should be used in conjunction with other metrics to get a complete picture of a company's financial health. Thank you for watching today's video on ROE. I hope you found it informative and helpful. If you have any questions or comments, please leave them below. Don't forget to like and subscribe to our channel for more videos on economics and finance.